and welcome to this special edition of Talking Economics on the Federal Budget. My name is Belinda Allen and I'm a Senior Economist here at CommBank, and I'm delighted today to be joined by our Chief Economist, Stephen Halmerick. Stephen, thank you very much for joining us today.
My pleasure. Thanks, Belinda.
Today we're going to unpack the federal budget, which was handed down on Tuesday. Now, there's always a lot of hype going into the federal budget. This time around, given the Australian economy is slowing, we've had a material lift in interest rates. There's still some concern about the inflation outlook. What are some of your initial takeouts from the budget?
Well, firstly, some good news in that we've got another budget surplus for financial year 2024, the year about to end, so just over $9 billion surplus. So that's the second surplus in a row. So that's a very good outcome. Certainly much better than most other major economies around the world who are deep in deficit. So that was good to see. And also the government's introduced a number of cost of living measures, particularly rebates on electricity bills and some help for rent that's going to mechanically lower the rate of inflation. So they're now forecasting inflation at 2.75% in the middle of next year, which will be inside the target range of the Reserve Bank. So that's the good news. The bad news is, though, that those surpluses disappear pretty quickly. So we're going to be back into a relatively large budget deficit for financial year 2025, and then an even larger deficit the year after, financial year 2026. And nearly all of that deterioration in the budget is due to government policies, spending more money. And we think in an environment, as you mentioned, where inflation's still pretty sticky, that does raise some risks.
So it sounds like we have a short-term view of the budget in terms of it mechanically lowering inflation. The Reserve Bank, given they have been quite vigilant on the inflation outlook, that could be good news for them. But at the same time, there is some more money flowing into the economy. Yeah,
exactly right. So over coming quarters, as the electricity rebates kick in, which is $300 for every household, so not means tested. And also for small businesses, $325, and an increase in rental assistance for some. And there's also the income tax cuts that start on the 1st of July. So there's a lot of changes coming in the next few months. And as we mentioned, those electricity and rental rebates will just mechanically lower the price of inflation because they're taking $300 off your bill. So that's good news. But given that the government is injecting a lot of new money into the economy, over $9 billion FY25, over $10 billion FY26. That's a lot of money in an economy that's already feeling these pressure points from lots of investment from state governments, lots of investment from the private sector, and that does, over the medium term, run the risk that inflation finds it hard to really stabilise down in that 2 to 3% target range.
We might come back to that point and talk about what that means for our Reserve Bank view later on. Before we get to that, though, let's talk about some of the key policy initiatives that were introduced in the budget. We had heard about the Future Made in Australia program over the past couple of weeks. We did get some more details in the budget.
Yeah, that's right. So apart from the cost of living measures, the other big centrepiece of the budget is this Future Made in Australia strategy. So it's a bit of a catch-all for a lot of investment incentives. The government estimates it's worth a bit over $22 billion, but that's over 10 years. So it's stretched out over a long period of time. And the real focus here is to encourage investment into energy transition, to the net zero strategy. They also talk about improving the resilience and the security of the economy. So it's really the government becoming more active in helping the private sector, both domestic private sector and global investors, invest capital in those big projects, getting us to net zero, energy transition, more security for the economy. So things like green steel, hydrogen, batteries, solar panels, all those things really going to get more government in support and encouragement.
And Australia's not unique in doing these sorts of programs. We have seen this in many other developed economies, particularly the US as well. So Australia is just really keeping pace with that. So that's going to add a lot of investment into the Australian economy over coming years. Some other key policy announcements outside of cost of living and the future made in Australia. Small businesses will receive another instant tax write-off.
Yes, that's right. So the $20,000 instant tax write-off for small businesses remains in place. So I think that'll be very well received. As I also mentioned, small businesses will get a discount off their electricity bills of $325 for the year. And there's incentives for things in like the housing sector.
Yes.
So, government money to provide more for housing, particularly social housing, build to rent, low cost housing, homelessness, as well as more money for skills training to get more people into that part of the economy. So for small businesses involved in the construction and the housing sector, I think that's pretty good news as well.
We also saw some more money for health, particularly the pharmaceutical benefit schemes, so more medicines will get added to that scheme, lowering the price. More on infrastructure as well, particularly Western Sydney and Southeast Queensland, so that just adds to the infrastructure pipeline we're seeing in Australia at the moment. So a lot of policy initiatives. Just turning our attention just to the economic forecast, one of our jobs is to really put a microscope on the economic forecast because they are so pivotal to the budget outlook. So looking at them, how did they compare to ours? And also probably population growth is another thing that we're watching very closely at the moment.
Yeah, so as we mentioned, the inflation forecasts are lower because of the government's policy, so at 2.75% in the middle of next year. That's lower than the Reserve Bank's own forecast, but the Reserve Bank didn't know about the government policies in the budget. And so our inflation forecasts are closer to the government numbers, so we think inflation will continue to decelerate. Particularly on the consumer is quite soft, which we can see through our own household spending insights data. If you look at the GDP numbers, the government's expecting economic growth this year of 1.75%, and then for next year, FY25 of 2%. They're both a little bit higher than our own forecast, but not hugely so, but a bit more of a pickup in growth expected by the government. Again, that's probably because they're providing some support. The unemployment rate, the government's forecasting to rise to 4.5% in the middle of next year. Our forecast is the same, so that all looks pretty reasonable. Where we do have some differences actually is in the commodity price forecast. So the government always takes a very conservative approach in their commodity price forecast. They're, for example, expecting iron ore to be down at $60 a tonne, US dollars a tonne, as at June next year. Our forecast is $92 a tonne. So if we're right on the commodity price forecast, then that's going to give some upside support to the economy and the budget.
And I will note that there will be another budget in March next year. The federal government has already announced that, given we are expecting an election in May. Now, I did say we wanted to talk about the outlook for the Reserve Bank, particularly in context of the federal budget. There is some more stimulus coming into the economy than we had expected. I think the impact on the economy, though, and the Reserve Bank could very much be driven by how much consumers do spend of these rebates, and that's really the big unknown at the moment.
Yes, exactly right. So, our base case is the Reserve Bank can start lowering interest rates in November this year. But we did say that one of the risks to that view is fiscal policy. And so now we have this really unusual circumstance where the budget is going to mechanically lower the inflation rate, so that should be good news for the RBA in their efforts to get interest rates down. But then they're adding more stimulus into the economy, which could push inflation back up again on a medium term. And as you say, so the big question is, we're getting income tax cuts for all income earners. We're getting electricity rebates for every household. What do people do with that extra money? Do they just spend it on other goods and services, which could push up prices? Or do they save it? Or do they pay down their debt? And there's been some surveys done where people are saying that paying down debt actually might be the best thing to do in this environment, given the relatively higher level of interest rates. So that's the big unknown. And I think the Reserve Bank will be watching the data very carefully.
As will we.
Yeah, as will we, of course, to see whether the extra money is being spent and pushing inflation back up, or if you like, the mechanical reduction in inflation is the dominant feature of the data in the coming months. So it's a long way between now and November, when we're expecting the first rate cut. There's 2 quarterly inflation readings to go until then. So they'll be the key to the monetary policy outlook.
And what about longer term? Because we did say at the start that the deficits are larger over coming years than we had expected as well. The investment pipeline in the Australian economy remains very large. That can be good news for inflation over the longer term if you increase the productive capacity of the economy.
Yeah.
But there's still a lot of work going on, a lot more money flowing into the economy than we had initially expected. Does it mean anything for the Reserve Bank over the longer term?
Yeah, so this informs what we call the neutral interest rate. So what level of interest rates are neither adding stimulus to the economy or being restrictive, and we think that's probably around about 3%. So we've got the cash rate getting down to 3.1% at the end of 2025 in our base case. But with the government putting more money into the economy over the medium term, everything else being equal, that would raise the neutral cash rate. So I think the Reserve Bank again will be watching that very, very closely. As they start lowering interest rates, how far can they take them before they see inflation pressures beginning to build again? That'll be critical through next year.
Stephen, it's been great to talk about the federal budget and to get your insights. Thanks very much.
My pleasure. Thanks, Belinda.